Hi guys, I welcome you all to today's lecture in which we are going to cover a very important RBI notification which has been issued recently, and this notification is going to be important for RBI and SEBI Grade A B examinations of 2019. Now this particular notification relates to the risk weight for the exposure to NBFCs, that is non-banking finance companies. Now before proceeding forward, let me quickly tell you about the excellent results that we have achieved over the past few years. Now in 2017, in RBI Grade B, we had 27 final selections from our students, and in NABARD Grade A, we had 11 final selections from our students. And in 2018, we repeated the same success story, and in RBI Grade B, we had 70 plus final selections, and in NABARD Grade A, we had 26 final selections. Also in 2018, for SEBI Grade A examination, 150 plus of our students, they got the interview calls, and for IBPS AFO, 100 plus of our students, they got the interview calls. Now if I talk about the different individual courses that we are providing, then they include RBI Grade B, SEBI Grade A, NABARD Grade A, RBI Assistant, and IBPS AFO examinations. Now, apart from running the separate courses for all those individual examinations, we are also having some combo courses which you can avail. So we have a combo for RBI Grade B, NABARD Grade A, and SEBI Grade A. We are also having a combo for RBI Grade B, NABARD Grade A, SEBI Grade A, RBI Grade B, and NABARD Grade A and SEBI Grade A. So we have all the requisite combos that you can choose from, and you can choose the appropriate course as per your requirements. Let me also tell you about our new course, which is very important for all the banking exams. This is the QRE course. QRE, that is quantitative aptitude, reasoning ability, and English. So all these aspects which are very important for all the banking exams, they are going to be covered in this particular course. So guys, this is the notification about which we are going to learn in this particular video. So RBI has recently issued a notification which is with regard to the risk weight for the exposure to NBFCs. Now we are all aware that when we talk about the balance sheets of the banks, they have to maintain a certain risk weights for all their assets in order to ascertain their capital adequacy ratio. Now, one of the important aspects of risk weights is with regard to the loans which the banks have given to the NBFCs. So this is with regard to the exposure of banks to the NBFCs. So this exposure has now been revamped a bit. So this notification, it deals with this particular aspect. So that's why it has been addressed to all the scheduled commercial banks, and it talks about the risk weight for exposure to NBFCs. It is guiding banks about what should be their risk weight if they are having exposures, if they have given advances to NBFCs, that is non-banking financial companies. Now this is a very recent notification which was issued very recently on 22nd February 2019. So let's learn more about this notification. So what does this notification say? Now this notification says that in a reference to the master circular on Basel III capital regulation, which was dated 1st of July 2015. So it says that this particular master circular, it was issued in 2015, and as per this circular, presently the claims on non-deposit taking systemically important non-banking financial companies other than asset finance companies, NBFC infrastructure finance companies, NBFC infrastructure development funds companies have to be uniformly risk weighted at 10%. So it says that there was this circular which was in accordance with the Basel norms, which said that the banks, they have to maintain the risk weight with regard to the exposure to non-deposit taking systemically important NBFCs other than these particular categories at 100%. Now what about these particular categories? It says that exposure to these categories, that is asset finance companies, NBFC infrastructure finance companies, NBFC infrastructure development funds, and other NBFCs which are not coming in this particular category. All these exposures, they were assigned, they were they were assigned weights on the basis of the ratings which were assigned to them by the rating agencies accredited by the Reserve Bank of India. So if the NBFC belonged to this particular category, the risk weight was 100%. It was assumed that 100% of the debt would be our loss. 100% risk was there with regard to this exposure. And for other NBFCs, it was not presumed that there is 100% risk exposure. It was presumed that it would depend on the rating of that particular NBFC by a accredited agency. So if that particular NBFC has a very good rating, then the risk is going to be lower for that NBFC and vice versa. Now, as per the statement and development and regulatory policy, which was very recently issued on February 7, 2019, as per this statement, it was decided that exposure to all the NBFCs will be risk weighted as per the ratings assigned to them by the rating agencies registered with the SEBI and accredited by the Reserve Bank of India or RBI. So simply this particular basket is now being expanded. Earlier this NBFC basket, it was limited. It was seen whether this NBFC belonged to this particular category or any other category, and on the basis of that the risk weighted exposure it was decided. But now for all the NBFCs, the risk weight is going to be as per the rating assigned by the rating agency, except there is one category which is core investment company. Except these NBFCs, all are now going to be as per the ratings assigned by the rating agency. Now, if the basic aspect with regard to the NBFC has already been discussed in one of the previous notification which we have just recently covered. So now we are not focusing on that particular basic aspect, but now let's cover another basic aspect which is related to the risk weight and capital adequacy ratio. Now this particular notification is primarily relating to the risk weight. Now what is the risk weight? Now risk weight means the amount of capital that banks have to set aside after giving the loans. Now suppose a bank is giving loan to me. Now bank feels that this particular person, I am going to return that amount, but there is a risk. Say there is a 50% risk amount. There is a 50% risk about whether I am going to return it or I am not going to return it. So it is going to assign me 50% risk weight. So that's why a risk perception is there, and on the basis of this risk perception, the banks, they decide what is to be the risk weight. If the risk perception is high, then the risk weight is higher. Now on the basis of this risk weight, a very important ratio is calculated for the banks, which is capital adequacy ratio. Now, for the purpose of maintaining this particular capital adequacy ratios, banks, they have to maintain proper capital in relation to their risk weighted assets. Now, risk weighted assets, they are calculated by looking at the bank's assets, the bank's loans, and we evaluate whether the loans the banks have given, we evaluate the risk of those particular loans and then assign them a weight on the basis of their degree of credit risk. For example, if the bank has given loan to government, then there is basically zero risk with regard to it and it will be assigned a 0% weight. But if the bank has given loan to an individual, it carries some risk and it may be given a 100% risk weight. And on the basis of this particular assigning of weights, we are going to calculate this capital adequacy ratio, which is going to protect the depositors, and at the same time it is going to promote the stability and efficiency of the banking and financial systems around the world. This ratio, it is going to ensure that banks, they maintain appropriate capital at all the times with regard to their risk weight assets. This particular ratio presently stands at 9%. So banks must have this particular ratio at 9% presently. Now, if I talk about the formula of this particular ratio, then this is calculated as tier 1 capital plus tier 2 capital. So on the numerator side, we have the capital, and on the denominator side, we have the risk weighted assets. So if our capital is 100 crores and our risk weight is say 1000 crores, then our ratio is going out to be 10%. So our capital should be commensurate with our risk weight assets. So this is calculated simply by dividing the capital of the bank by its risk weighted assets, and within this particular capital we are going to divide this capital into two tiers. One is the tier 1 capital. This is the capital which can absorb the loss without a bank being required to cease trading. So we are not closing any bank, we are not winding up any bank. We are just trying to see if we do not close a bank, how much capital the bank has which can meet certain liabilities of the bank, which can meet the losses of the bank. And there is another tier 2 capital which will come into play once the bank is wind up. So it is that capital which can absorb losses in the event of winding up. So it provides a lesser degree of protection to the depositors. Now, the tier 1 capital, it is also referred to as the core capital. It comprises equity capital, ordinary share capital, intangible assets and audited revenue reserves. While the tier 2 capital, it is the unaudited retained earnings, unaudited reserves and general loss reserves. Now tier 1 capital is the pure, it is the core capital, but tier 2 capital is not the pure, it's rather the impure capital. So we just have to set this picture in our minds that this is the ratio, this is the role of risk weight assets in the banking parlance, and now we are going to understand how this particular scenario is going to come into play with regard to this particular notification. So if we take a look at this particular notification, it is basically RBI cutting the bank loan risk. Now before, the bank loans which were given to NBFCs, they were not always linked to their credit rating. So we were not concerned what is the credit rating of this particular NBFC. We were just following some rates, and in many cases this rate was 100%. We were just assigning this 100% risk weight, assuming that entire loan which has been given to NBFC, it will be a bad debt, it will be loss for the bank. So if the bank was to maintain such a high provision with regard to loan to NBFC, automatically the bank used to be very cautious about lending to NBFC, and that made the whole picture complex, and the cost of funds for NBFCs, it became higher. But now the RBI has cut the bank loan risk. Now RBI has mandated that the loans to all the NBFCs has to be linked to their credit rating. So if an NBFC has a good credit rating, you should assign a less risk to that particular NBFC, so that you can give more funds to that NBFC without worrying about maintaining proper capital, or without worrying about maintaining proper capital adequacy ratios. So this was the position before the notification. Before the notification, we used to classify the bank's exposure to non-deposit taking systemically important NBFCs and other NBFCs. We used to do this particular classification, and for the non-deposit taking systemically important NBFC, we maintained a risk weight ratio of 100%, and for the other NBFCs, we maintained a risk weight ratio which was as per the ratings which were assigned by the rating agencies accredited by the RBI. So we were classifying it into two parts. But now what's the new scenario? The new scenario, as per the statement on development and regulatory policy, is that the exposure of all the NBFCs except there is now one category which is still left out, core investment company, will be as per the rating assigned by the rating agency. So now the risk weight is going to be as per the rating assigned by the rating agency. But for the core investment company, the risk is going to be weighted at 100% only. So on the whole, this is good news for the NBFC sector, because now the banks, they have to maintain less capital margins with regard to their loans to NBFCs, and this is going to give some leg room to banks to expand their lending to the NBFCs. Now let's talk about how this notification can be seen in a very simple terms. Now, as per the Basel norms which are followed by the domestic banks, there is a risk weight of 20% for AAA rated corporates and 30% for AA rated corporates. So as per the Basel norms, it has been provided that if you are lending to corporate, you have to see its credit rating. If it is having AAA rating, then you have to maintain risk weight of 20%. If it is having AA rating, you have to maintain risk weight of 30%, and so on. For a company which has a lower rating, the weight stands at 50%. And now this particular same system is going to also apply for the non-banking finance companies as well. So this is a good news for NBFCs. Now presently what happened was, presently the exposure of banks to certain categories of NBFCs such as housing finance companies, asset finance firms, infrastructure finance company and infrastructure development funds, they were already linked to their credit rating. But for some of the certain categories, it was not linked to their credit rating. But now those also are going to be linked to the credit rating except the core investment companies. So now if the NBFC is having AAA rating, it is going to get a cheaper loan. It is going to only have a risk weight of 20%, and similarly for AA rating, risk weight is going to be 30%, and for lower it is going to be 50%. So now this is on the positive side for NBFCs. Now, if you talk about the impact of this particular move, then the reduction in the risk weight for NBFCs, this is expected to free up the equity capital for banks. So now the banks would not be required to maintain a high amount of capital adequacy ratio with regard to the loans to NBFCs. So this is going to free up the capital of the bank, and they can use it for lending more money to the NBFCs, or they can use this particular money for some other judicious purposes. So this particular step is largely expected to benefit the loan companies, as now their risk weight is going to fall to 20 to 50% from the earlier 100% category. So this has the potential to improve the credit flow to the loan companies, bringing them on par with the asset finance company, housing finance company, and infrastructure finance company. And it is also going to lower their borrowing cost, particularly for the AA and below rated entities. So now the cost of borrowing for NBFCs is going to be lower, and at the same time more credit is going to flow towards the NBFCs. But then again, there is a cautious note that this all depends on the bank's willingness to do so. If the banks are not willing to lend money to the NBFC, this is not going to happen. This will only happen if the banks they show their willingness in doing so. So guys, this was all about the notification. Now let's take a look at some of the important questions which can be framed out of it. So let's start with the first question. In its recent notification, RBI has decided that exposures to dash will be risk weighted as per the ratings assigned by the rating agencies registered with SEBI and accredited with the Reserve Bank of India. Options are all NBFCs including core investment companies, all NBFCs excluding core investment companies, all NBFCs excluding the lending companies, or none of the above. So guys, as we have seen that as per the recent RBI notification, if the exposure is to NBFCs, then they are going to do this risk weightage as per the credit rating assigned by the rating agencies, and this is going to work for all NBFCs now except the core investment companies. So this our answer is going to be option number 2. Next question, which of the following is correct about a risk weight for the banks? A risk weight is the amount of capital that banks have to set aside after giving the loans. Banks have to set aside more money for loans with a relatively high risk. The exact amount of capital that banks have to set aside for the weights also depends on their capital adequacy ratio, or all of the above. So we have seen that all of these, they are the features of the risk weight for banks. So our answer here is going to be option number 4, all of the above. Next question. The correct formula for capital adequacy ratio is, options are tier 1 capital plus tier 2 capital divided by the risk weighted assets, risk weighted assets divided by tier 1 capital plus tier 2 capital, tier 1 capital into tier 2 capital divided by the risk weighted assets, or none of the above. So we have seen the ratio we have seen the formula for this capital adequacy ratio, and we have seen that the correct formula is tier 1 plus tier 2 capital divided by the risk weighted assets, and option number 1 is going to be our answer for this one. Next question. In computation of capital adequacy ratio for banks consists of equity capital, ordinary share capital, intangible assets, and audited revenue reserves. Options are tier 1 capital, tier 2 capital, both of the above, or none of the above. So this we have seen that the tier 1 capital is the one which consists of equity, ordinary, intangible, and audited revenue reserves. So our answer is going to be option number 1 for this one. Next question. RBI has recently announced a reduction in the risk weight for NBFCs to be maintained by the banks. The move will lead to which of the following? Incremental credit flow for NBFCs, reduced credit flow for NBFCs, increase in interest rates for loans to NBFCs, or none of the above. So this we have seen that with regard to the recent RBI announcement, this reduction in the risk weight for NBFCs, this is going to lead to incremental credit flow for the NBFCs, and thus our answer is going to be option number 1. So guys, here are the solutions to all the questions. So guys, this was all about our discussion. If you are having any query, you can mail us at hello@edutap.co.in, or you can reach us at 8146-207-241. You can call us or you can WhatsApp us. And I would also recommend that you visit our website www.edutap.co.in for regular updates and important content on the respective examinations. Thank you guys. I wish you happy learning and all the best from the entire team.